Coming up on Market to Market. New data suggests the EPA has dramatically underestimated U.S. methane emissions. And the Farm Bill stalls in conference committee, largely over differences in spending on nutrition. Those stories and market analysis with Virgil Robinson next.
This is the Friday, November 29 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The American Automobile Association estimates more than 43 million Americans traveled at least 50 miles during the Thanksgiving holiday weekend. That's down 1.5% from last year, and 90% of those venturing over the river and through the woods did so by automobile. Motorists are undoubtedly thankful for cheaper prices at the pump. Gasoline prices fell to a 3-year low earlier this month, and while the national average price for regular unleaded rose slightly this week to $3.29 per gallon, motorists can still find gas below $3 in many states. Record supplies of crude oil are helping keep a lid on prices. Domestic crude production is at a 24-year high, while foreign oil imports are at a 17-year low. And the U.S. produced more crude in October than it imported for the first time in nearly 2 decades. Still, Congress is looking to add more fuel to the domestic energy boom. Prior to leaving for the holiday, House lawmakers approved 2 bills aimed at speeding up drilling for oil and natural gas on public lands. But in a development this week, which could impact those drilling for crude, as well as those raising cattle for food, scientists reported that government estimates on U.S. methane emissions are way too low.
The recently released study shows the Environmental Protection Agency may have underestimated the levels of certain greenhouse gases by as much as 50%. The scientists involved in the study say the increase can be attributed to higher levels of methane gas associated with cattle and oil production. According to estimates by researchers at the Carnegie Institution for Science, methane levels hit 49 million tons between 2007 and 2008, 16 million tons higher than the closest EPA estimate. Methane is 21 times more potent at trapping heat than carbon dioxide, the most abundant global warming gas. The results led the authors of the white paper to question EPA's recent decision to cut its estimate of national natural gas emissions by 25 to 30%. A spokeswoman for the EPA says the agency hasn't had time to go through the study yet, but it hopes it will refine our estimates going forward. The study was funded by an alphabet soup of government agencies, including the Department of Energy and the National Oceanographic and Atmospheric Administration. Researchers used data from 13,000 measurements taken by scientific instruments mounted on airplanes and the top of tall buildings. The states with the highest methane emissions were Texas, Oklahoma, and Kansas. Of the 3 states, Texas has the largest number of oil refineries. Both Texas and Oklahoma are major oil and gas drilling states, and all 3 states rank in the top 5 for cattle production. Large discrepancies were found in government data, particularly in the nation's south-central region, where total methane emissions were 2.6 times greater than those previously reported. The paper published in the Proceedings of the National Academy of Sciences indicates that emissions due to cattle flatulence and manure were as much as 2 times higher than levels registered in EPA and European Union greenhouse gas inventories. Also, emissions from oil and gas production in the same region could account for nearly 50% of all methane output, 5 times higher than shown in most commonly referenced global emissions databases.
Prospects dimmed last week for a farm bill before the end of the year. House Agriculture Committee Chairman Frank Lucas acknowledged it would now be very challenging for him to meet the Republican leadership's schedule of having a final agreement back on the House floor by December 13th. The Oklahoma Republican had pushed for the framework of a deal before the Thanksgiving recess. But after several face-to-face meetings between House and Senate leaders, Lucas acknowledged that negotiators had made little progress. Congress failed to approve the Farm Bill in 2012, and now it's at risk of doing the same thing in 2013, pushing the measure into yet a 3rd year of debate. Lawmakers are still at odds over the fine print in the commodity portion of the Farm Bill. And then there's the polarizing issue of federal nutrition programs. John Nichols examined the numbers and filed this report.
In the wake of the worst economic downturn since the Depression, The Supplemental Nutrition Assistance Program, or SNAP, grew dramatically. According to the Nonpartisan Congressional Budget Office, the rates of participation and spending on SNAP both soared to record levels in 2011. In an average month that year, nearly 45 million people, 1 out of every 7 U.S. residents, received SNAP benefits. The result? Federal spending for the program formerly known as food stamps ballooned to an unprecedented annual cost of $78 billion. Both the House and Senate have approved reductions in nutritional spending. The Senate measure would cut SNAP by $4 billion over the next 10 years, while House lawmakers want cuts of nearly $40 billion. And critics say SNAP spending is out of control.
I'll continue to work with my colleagues to implement reforms in the SNAP program, to cut back on waste, fraud, and abuse in the program to ensure that those funds are available to those who are needy. The cost of SNAP has more than doubled from 2008 to 2012, as have the enrollees, gone from 28.2 million up to 47.7 million.
Proponents insist SNAP is one of the government's most effective anti-hunger programs, and they claim it's helped millions of low-income families, children, and seniors. According to the CBO, SNAP kept nearly 5 million Americans out of poverty in 2012, including more than 2 million children. Critics, however, are calling for numerous reforms, including more rigorous work requirements. But the man charged with administrating the largest program in the domestic hunger safety net says tougher work requirements would do little to cut spending.
Here's what people do not understand about the SNAP program. 92% of people receiving SNAP are either senior citizens, people with disabilities, children, or folks who are actually working today. So when we talk about work requirements, we're only talking about 8% of SNAP beneficiaries. Of that 8%, the current law says that if they are not getting a job, if they're not in an education program or training program, they only get 3 months of benefits every 36 months.
Last week, the Center on Budget and Policy Priorities cited government data revealing that SNAP spending as a percentage of gross domestic product actually declined slightly in fiscal year 2013. The researchers project SNAP spending will continue to fall by nearly 5% in fiscal year 2014. And as the economic recovery continues and fewer people qualify for SNAP, the CBO expects spending to continue to decline and return to its 1995 levels by 2019. But that may be of little consolation to farmers and ranchers whose management decisions are highly influenced by government policy. And with the growing likelihood that congressional debate on the Farm Bill will stretch into a third year, Vilsack reminds agricultural interests that they too benefit from nutritional programs.
The SNAP program is also about that farm safety net, because if folks can buy more at the grocery store, they're in fact going to buy more, and it helps to stabilize farm prices. 15 cents of every food dollar spent in the grocery store ends up ultimately in a farmer's pocket. So it is part of the safety net in addition to helping out struggling families.
If Congress fails to approve a new farm bill by year's end and does not extend the 2008 law again, U.S. farm policy will revert to the last permanent farm bill of 1938. Those provisions were last updated during the Truman administration, and experts say the antiquated policies could send prices sharply higher, especially for dairy products. For Market to Market, I'm John Nichols.
Next, the Market to Market Report.
We're producing this episode of Market to Market on Wednesday to allow the people who bring you the program each week an opportunity to spend Thanksgiving with family and friends. And during the holiday-shortened week, grain prices were mixed. As of Wednesday's close, March wheat gained 6 cents, while the March corn contract moved 3 cents lower. Soybeans traded sideways during the abbreviated trading week as the January contract settled fractionally higher. Nearby meal prices followed suit, advancing by more than $8 per ton. In the softs, cotton's put together a winning week as the March contract advanced by $1.21 per hundredweight. In the dairy market, December Class 3 milk gained 39 cents, while the January contract moved 38 cents higher. Over in livestock, February cattle gained $2.30. Nearby feeders advanced by $1.82, and the February lean hog contract posted a weekly gain of 80 cents. In the financials, the euro gained 11 basis points against the dollar. Crude oil declined by $2.50 per barrel. COMEX gold lost $6.70 per ounce, and the Goldman Sachs Commodity Index declined by nearly 4 points to settle at 621.30. Here now to lend us his insight on these and other trends is one of our regular market analysts, Virgil Robinson. Virgil, welcome back.
Thank you, Mike, and happy holiday to you and our viewers.
And as well to you, Virgil. We're glad to have you here. We've got a lot going on around the world. We're getting to that time of year where we start to get forecasts coming out of every other place. What are we hearing? How do things look on the worldwide stage?
Mike, our forecasts for world GDP are improved 2014, 2015 versus this year. World GDP will grow about 2.3 or 2.4% in 2013. We're looking for about a % increase in 2014. So that will, I think, underpin demand as we continue to think over the course of time about this growing and more affluent middle class. In the context of economics, maybe we should add here, Mike, on Thanksgiving week, on an inflation-adjusted basis, the U.S. farm income for 2013 will be the best it's been in over 4 decades.
Wow.
On average, not all, on average, most producers' debt-to-asset, debt-to-equity ratios are the strongest they've been in many, many years. So clearly, we do have much to be thankful for.
Yes, indeed. Now, as you mentioned, we're seeing world GDP rising as a whole. What are the bright spots? Who is really growing here or projected to grow through the remainder of this year?
You know, I think, Mike, the U.S. will be amongst the leaders. Now, again, clearly there are headwinds, and there are issues that must be, in fact, resolved or at least addressed, and I think they will be. Great Britain is another region which for the last few years has been relatively stagnant, and I think it will grow. The old BRIC group, again, China's growth has slowed, but to suggest it has stopped would be very misleading. Their economy is kind of switching to a more consumer-driven economy than in years past, but I think, and our forecasts are suggesting about an 8% growth in 2014. There are other countries growing, the likes of Mexico, parts of the southern Pacific, areas that are, I think, growing more accustomed to improved living styles and behaviors, and that certainly should help underpin demand for a lot of goods and services, including agricultural product.
Certainly. And as we look at the broader equity markets in America, especially, we've seen record high after record high and another record high this week. Is that increasing global demand a major driver of that, or are those primarily American policies, you believe, causing that equity run-up?
I think the growing affluence globally, you know, we've addressed the growing middle class on many occasions. I think that still pertains and forecasts growth that will be consistent and genuine, and certainly will have competition to meet that growing demand, but it certainly does give us an awfully good opportunity moving forward here in terms of agricultural product.
You bet. As people grow a little more affluent, they like to eat a little better, and hopefully that'll come home to us.
Livestock and dairy intake or consumption, I think, will continue to grow, Mike, over the foreseeable future.
All right. Well, let's take a look at the wheat market. We did see a bit of a run-up this week on wheat. We've been in a trading range recently. Where is the wheat market positioned as we look to the future?
Well, it's been declining, Mike, for quite some time. You know, again, the underpinning to that market, and I'll define that as, and I use this often, the global and the U.S. stocks-to-use ratios, they're at 4- and 5-year lows respectively. I think any hint of significant weather trauma, and as we head into the hard red winter wheat dormancy period, that crop's in relatively good condition, but certainly there's a winter here to endure. And some are of the opinion it will be unusually harsh through that part of the country. So should that come to fruition, certainly that could create some additional interest in wheat and some price improvement. I think, at least as of tonight, the soft red, the hard red spring wheat contracts, I think seasonally are positioned here for some modest improvement into that February-March period. And let's just define that tonight by a 40 to 60 cent rise from prevailing values. I would certainly use that, Mike, to market some old crop wheat and certainly look seriously at your crop budget and what type of profit or margin might be available for new given those circumstances.
Certainly know when you can take a profit and put a little in the bank account.
You know, I think with margins tightening, Mike, marketing plans become more important, risk management crucial, and cost savings matter a great deal.
And another market where that's just as relevant, of course, is the corn market. We've seen increasing production costs in that market while we've seen the price continue to slide and slid a little bit down this week, down at 3 cents or so. Trend continue downward, or do you think we're possibly in a range?
Well, there's been good demand. Ethanol margins are profitable. Export sales and shipments have been brisk early on here in the crop year. As mentioned, or as we'll discuss, I think, in the next few minutes, it would be my opinion that the U.S. hog herd will grow over the next several months, as we've now had 5 consecutive months, at least based on Iowa State data, of profitability, and that historically has been the trigger for expansion. Egg sets and chick placements have increased pretty consistently the last several weeks. So we're building, a pretty good domestic demand base there, Mike, and a relatively strong export sales book. So that combined with, and I looked just before we came on here at the 3 and 5 year seasonals in corn, and more often than not, there's kind of an irregular price improvement from about this time of year into the late winter, early spring of each year. So I think there'll be an opportunity over the next several weeks at a better price for old crop corn that yet remains in farmers' hands, in producers' hands, as well as ideally a little improvement in new crop value.
As we continue to see if that demand is going to continue to grow, particularly, I suppose we're looking mainly at export demand, continued growth, and then the domestic demand, particularly the livestock side, will that continue to expand enough to meet the needs of a 2 billion bushel carryout?
Well, I think we could argue, Mike, that the USDA balance sheet could change and the ending stocks could decline modestly. Now, I'm not suggesting here a major decline in supply. Supply is very adequate, and I think everyone's in tune with that. But there'll be some opportunities, I think, as we move forward here. And there'll be some periodic strength in the corn market. And I think one of the factors will be corn has been stored on the farms, and on-farm storage has expanded over the last 4 or 5 years. And as earlier mentioned, most of their balance sheets are as strong as they've ever been. They're going to be pretty firm holders of that commodity, Mike, in an effort to try and create demand because of their efforts to hold grain tightly. So there'll be some periodic spurts that I think we can take advantage of that will be better than tonight's values.
All right. And now, as you mentioned, farmers holding things back, so probably producers in areas where there's a lot of on-farm storage should be keeping their eye out for substantial, or at least basis improvements in their neck of the woods. As they withhold it, that's where you're going to recognize that shortage of grain first.
The strength in cash could clearly be a manifestation of their local basis, but if combined, hopefully, with some seasonal improvement here. Now, I'm not talking about $1 a bushel, Mike. I'm talking about something less robust than that. But I do think there'll be some opportunities to meter that grain to the marketplace at values as good or better than tonight.
All right. Now let's take a look at soybeans. Now that's a market that we were in a little bit of a downtrend 2 weeks ago. Last week, We broke free of that, pushed north of $13, and we seem to be holding steady. Is that primarily export driven?
I think it's certainly part of it, Mike, and we did buy a bunch of beans in the last few days. Having said that, at least the way I calculate it, the local spot basis really has not suffered much. So I think what's happening there is, at least in the old crop part of the soybean market, you've got dual demand pulls, that being export sales and shipments, which have been strong to this point, as well as a real strong interior demand from the processor. The way I calculate processing margins, they're much better tonight and on forward than they were a year ago. And as long as there's profitability in buying and processing beans, the demand will be brisk and strong.
All right.
So I think that'll create some old crop opportunities here moving forward.
And now the hedge on everybody's bet when we look to the future is South America's still planted a record soybean crop, if I'm not mistaken. Right. How are we looking weather-wise down there? Does it look like so far that crop is growing?
Yeah, to the best of my knowledge, there are no major concerns. However, given my experience in the industry the last many years, Mike, there seems to be inevitably at least one concern with that crop through the cycle. So whether it's weather or pests or some combination of the two, political issues, strikes, logistics, all those things will come into play. So there'll be some periodic opportunities, I think, in the new crop contract, in lieu of the fact that U.S. acreage is projected to increase this coming crop cycle 4 to 5%.
All right.
So clearly we need to acknowledge that supply at present is not a major concern, but there are enough demand factors at present to give us some periodic price improvements.
All right. Now, last year, as we watched the spring roll into summer, we never really saw the price of U.S. beans fall off to the level that we had been talking on market to market in the springtime, because South America was never able to get their beans out in a timely fashion. Is that projected to increase, or are they making strides on their infrastructure?
Well, I think they're making strides. Mike, statistically, there were a number of reputable sources that brought to our attention on a month-over-month basis the combined lifting and exporting of beans and products out of both Brazil and Argentina was record large. So, you know, the old thing is show me the money, and clearly that creates a big incentive in many regards.
You bet. Now, as we take a look over at the livestock markets, we've seen fat cattle go on a little bit of a run just this week. We saw cash prices come up a little bit in a lot of places in the Corn Belt. Is this strength in the cattle market long-term on the fat side, do you think?
Well, I think the supply issue's been well discussed on the show. I don't sense any significant increase in beef supply until at least 2016. The issue has really been, can we sustain higher retail price export trade given the numbers and the increase in value of that product? And my answer simply would be yes, I think we can. And we kind of discussed that earlier in the show with respect to the growing affluence worldwide-wise. Do I expect a straight-up ascent in the market? No. But over the course of the next many months, I think beef prices will continue to irregularly move higher. Replacement values, again, I think it's, I forget the date in January, we'll have our annual cattle and calf inventory report, and I think it will indicate and show for the 8th consecutive year a decline in beef cow inventory.
All right.
So clearly that supply is not going to replenish or grow significantly for quite a long time.
And now that leads us right into the feeder cattle market. If we're not having cows, we're not having calves, we're going to see that market continue to stay very tight for some time.
Yeah, I think conditions have improved, you know, pasture conditions, and there'll be an effort to grow the herd, Mike, but it doesn't happen overnight. And therein lies my thoughts about beef supply. I don't think it's going to grow much. It'll probably decline through 2014. I don't think it'll grow much for the next couple of years.
And then once we do start to grow, it's basically a 3-year timeline to kind of gain back what we've lost to date. Is that the number that the market's still using?
Yeah, I'm kind of incorporating the next couple of years as part of that scenario.
Okay.
Mike, yeah.
All right. Now, that's on the beef side. As we take a look at the hog market, we have seen a little bit of a rise in hog prices. Again, we're seeing numbers increase, as you mentioned. Does the hog market have staying ability here where we're at today?
You know, I think it does. Hard to really document that, but I'll make an effort here. The October cold storage report indicated a 6% year-over-year decline in total frozen pork inventories. Now, that comes at a time where retail pork prices were at an all-time high. So clearly the demand, at least as measured by this simple illustration, is pretty darn strong. Now, exports have declined year over year, Mike, and that's a matter of concern, but I think they'll improve in 14 and 15 as the dollar kind of flattens, and at least in my mind, will most likely weaken. So I think hog prices are pretty darn solid for the next several months. As mentioned, Iowa State brought to our attention 5 consecutive months of profitability has historically triggered an effort to increase hog numbers. Should that come to fruition, no reason to believe it won't, particularly with less expensive feed. We need to be concerned about the fourth quarter of 2014 forward, and the futures market has already acknowledged that. All right.
Now, as you mentioned, Iowa State showing growth. In the past, historically, has there been a percentage increase in hogs that we see after that 5 months of change, or does it vary each time we get that?
Yeah, I think I don't have an answer for a percentile growth, Mike, but again, given the profitability and those producers, bless their hearts, that made the transition from very difficult times to better, I think now are in position to grow their herd and do so profitably. So there will be growth over the course of the next several months.
All right. Thank you so much, Virgil.
Thank you, Mike.
That wraps up this edition of Market to Market. But Virgil and I will continue our discussion and answer some of your questions in our Market Plus segment on our website. You'll also find audio podcasts and streaming video of our program, as well as links to our Twitter feed and Facebook account exclusively at the Market to Market website. Be sure to join us next week when we'll visit the first public hearing on the Obama administration's proposal to reduce the amount of ethanol in America's fuel supply. Until then, thanks for watching. I'm Mike Pearson. Happy holidays.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.